David Bacher, lovely to have you with us this month for the Corion Report and an update. It's been an interesting year, which is needless to say. And September's Corion Report was titled bearishly "The Nightmare on All Streets." What have we seen happen in the market since then?
Thanks, Lucy. If your listeners can recall, despite how bleak asset class returns were as at the end of September, the previous Corion Report actually ended with the famous musical song, "The Sun Will Come Out Tomorrow." Fortunately for the benefit of our clients, the sun indeed came out. Global markets largely reversed last month's downturn. If you take the Dow Jones, for example, it returned 14% for the month, and that is the highest monthly return since 1976. But I think if you look more broadly, the MSCI All Countries Index is a better indication, and that was up 6%. So there was a lot of despair last month. We tried to tell people not to capitulate. Things tend to overshoot on the upside and the downside, and thankfully there was a lot more green on the scorecard for October.
What was the reason for the rally?
It's a hard question to answer. In our opinion, the two primary reasons for this. Firstly, many market participants started to believe that the Federal Reserve will soon take a break from its series of aggressive interest rate hikes. And secondly, the corporate earnings seasons in America is well underway, with about half already reported earnings. And although earnings weren't great, many investors' fear of earnings collapse didn't happen. So a little bit of good news in this environment goes a long way.
It's interesting that you say that, because we saw quite a ruction last week with tech stocks. As you say, earnings have been coming out. And when reading analyst reports and reviewing what's going on in the markets, it seems like there's a lot of uncertainty in spite of the positivity that you've just mentioned.
Well, I think if I have to carry on with any theme, I guess I should say it's been a hard knock life for some. And none more so than, I suppose, Meta, which was down 30% in the month and is down 67% for the year. And, I think that company certainly needs a bit of a reality check, pun very much intended there. But I think the lesson for the technology free for all of us is that, what matters when you pay and you buy into a company is not how great the company is or its future growth prospects. Obviously, those are important, but it's the price that you're paying for that future growth prospects. And things got very lofty and very elevated in terms of valuations. And thankfully, we were underweight that sector. But, if you were overexposed there, you would have taken some pain.
There's certainly been a huge amount of pain. And as you said, with global central banks movements, there is certainly a great amount of discomfort. We've got decisions coming up. Are there expectations of coming from Corion? And do you have a view on that and how you expect to see it play out in your market?
In our market, in terms of South Africa, I think we're actually in a good place. Our Reserve Bank has been very much ahead of the curve. Inflation is at a much lower level than compared to Europe and America. And, our valuations never got to the lofty levels of overseas. So last month we said local is lekker. And that was a relative valuation mostly compared to the United States. And we stand by that. Unfortunately, the strong dollar is something that we have got wrong over the last couple of months. But we do think that the dollar is at extreme valuations relative to most other currencies, especially the rand. So we still stand by the fact that South Africa isn't a bad place to invest.
So you still see that South Africa Inc. and stocks, as it were, on the JSE are on a fire sale in spite of the dollar. There are predictions that the dollar hasn't seen its surge. Do we still think that there is value in spite of that?
We definitely think so. If you look at our market last month, although the headline number was probably a little bit lower than global markets in dollar terms, you take out NASDAQ and process, which is a big weighting, which that's not where we're overweight in terms of our allocations. You had financials up 12% last month. You had industrials up heavily. There are a lot of shares in South Africa, and even our bond market that's offering investors a good dividend yield at shares that we don't believe are expensive relative to its long-term history.
And following that, in terms of the rally that we did see in markets, in spite of the nightmare on all streets, as we saw, emerging markets haven't actually seen the same kind of rally.
Yes, indeed it has. I mean, the strong dollar is very much not a good recipe for emerging markets to rally. But even putting that aside, if you look at last month, the MSCI Emerging Market Index was actually down 3% while global markets took off. And that's a headline number that looks a little bit concerning. But, the main reason for this was China. And China is 26% of that index. And the Hang Seng fell almost 15% in October. And that's the most in 14 years. So, you've got to understand that other emerging markets actually did do well. Brazil was up 8%. And China has had its, unique specific issues in addition to other markets. The very restrictive COVID lockdown has certainly hurt. They had the Communist Party leadership that wasn't seen favorable from the market. So strip out China, emerging markets actually haven't done that badly despite a very, very strong dollar.
And David, just mentioning all of those global players, we have China, we have Japan. There is a lot happening with the yen and, again, those central bank movements. A lot of analysts are looking at the markets at the moment and saying there are certain indicators that suggest that we are in a global position of a stage step that is looking to change the environment that we operate in. Is that something that Corion is also looking at?
We're going through big changes in the geopolitical investment community, the polarization from the left and the right, and inflation. These are phenomena that make people think, that create some kind of unease. It topples governments. So this is part of the puzzle that you've got to piece together as an investor. The risks are increasing. We are aware of that. Inflation, increasing disparity of incomes, this creates tensions. But given that, those risks are, you can say, to some extent in the price. Markets have depreciated significantly and come off from lofty valuations. So at Corion, what's our first and foremost principle? We long-term investors, we look at valuations, and we make our most informative decision or our primary decision based on, do we believe that the future revenue streams and income will give us enough reward for the price we're paying today? And we think, despite the risks you mentioned, we think that you don't have to shy away from equity markets at this stage.
That's a good point. There is certainly reticence in the market, and as you say, it's been priced in. And should investors be approaching that with fear and uncertainty, or the knowledge that, in spite of ructions, there will be a stable outcome in spite of speaking about an 18 to 24 month recession?
Correct. I think a lot of, and maybe we contribute this with this Corion monthly report, but it is only 1 month. If you're investing in equities, you're investing in an asset class that over a long period of time produces you compelling real returns. That's a wonderful gift at the end of a long journey. But the short-term volatility is hard to endure. but must be expected. So, it's not the first time we've had this kind of volatility. It's not going to be the last time. It's actually the price we all pay for better real returns at the end of the day. And just because we've had a difficult 1 year in the equity markets, this isn't the time to be turning your back on risk assets.
If anything, it might be a good time to buy.
Yeah, look, we're not overweight. I'm coming across like we're really waving the flag for being overweight, and there's no problems in the world. But when we speak to clients and we hear the concerns and listening to people around the table, you've got to guard yourself against being too pessimistic and still sticking to a long-term plan. And going from what was a year ago, I want to invest in Meta, I want to invest in technology shares, to where we are today, those kind of extremes are dangerous. Rather stick to a long-term plan of investing, make sure you've got a diversified portfolio, and be conscious that over a period of time, you will endure and will have to endure some drawdowns.
Keep a cool head, be patient, and keep that long-term view in place. For sure. In terms of that and Corion's view to asset classes, are there asset classes that you are viewing with a negative outlook?
I think it's back to how we define asset classes at Corion. Broadly speaking, asset classes are mainly broken up into equities, bonds, property, and cash, and then you can probably further break that into local and offshore. In terms of how we're thinking of things at Corion, is we probably the most bearish we've been on offshore dollar investments and offshore dollar cash specifically, for the reasons I mentioned before. We think the dollar has been on a tear for some time, but we think it's late in the game, and other currencies relative to the dollar are starting to offer more value.
It's very, very interesting, and especially in terms of, as you mentioned, that volatility and where investors are looking to put their money. Thinking then of hedge funds, and we've touched on it. We had a very interesting interview with Cy Jacobs. He's very bullish on hedge funds. Do you have a view on that?
Absolutely. I think we at Corion are actually well qualified to speak on the topic. We manage one of the longest running hedge funds in South Africa. It spans over 2 decades. And the truth of the matter is that the South African hedge fund industry has done an amazing job, and especially during this recent period of heightened volatility. Our team was looking at not only our fund returns, but our peers and our competitors, and the majority of local hedge funds has done an amazing job for their clients. It's just such a great pity that the South African hedge fund industry has not attracted the assets that we believe it should have.
Expand on that. What do you mean when you say it hasn't attracted those assets?
So I think hedge funds got caught up in the crossfire. Hedge funds are generally more expensive than traditional investments. And unfortunately, the South African investment industry has focused so much on cost, which has overshadowed them seeing any other benefits. And cost, while a very important aspect of any investment decision, should not be the only factor. And some of the other factors that I think investors need to consider, which are often ignored, are factors such as, does the strategy have capacity constraints? Is it a truly active strategy? Does it blend well with a less expensive passive investment? Will it provide my portfolio with diversification benefits? So, I've had many meetings where a client has asked me to show them our MDD or another MDD, which is a fund fact sheet, a summary of the fund's performances and costs and notable disclosure information. And the first thing a lot of investors are doing are looking at the cost of the fund, which is, in my opinion, the wrong way to start. You started looking at the long-term track record of investments and then the price you're paying for that. And I just think the pendulum has just swung so much that has often been to the detriment of this part of the industry.
Do you think that there is an aspect of a lack of understanding of what hedge funds can offer in terms of financial literacy and education, and a barrier to entry because of that?
100%. And hedge funds, admittedly, are only focused on cost, and there are other aspects which I haven't touched on. And complexity is definitely a factor. Hedge funds are more complicated for investors to understand. So, the man in the street needs to be careful of investing in a hedge fund. I understand that. I just think if you go slightly up the chain in terms of financial advisors, allocators of capital, that burden shouldn't be as high, and they should be in a position to get their clients across the line more easily.
And do you see that changing in the industry?
I think so. We've definitely noticed a lot more interest from our side as well in our hedge fund portfolios. I think when you had a bull market from 2009 globally to 2021, everyone wanted to be in equities. And the beauty of a hedge fund, in theory at least, is that when volatility is high, hedge funds can actually deliver a real return regardless of market stresses. And that certainly has been the case. So it's played out as hoped. And investors are now, I think, starting to see the benefits of having a different kind of return stream in their portfolio mix. So I think that's going to be a big factor in getting investors, as I said, across the line, which previously they haven't.
Mm-hmm. Especially, as you say, in terms of going from a bull to a bear, which is, I think what we're looking at, and in terms of the prognosis that you now expect for the month of November, are there any salient points that investors, clients should be aware of?
Expect volatility. We've come on the show, I think, 4 months in a row almost, and the markets have either been up 5%, down 5%, and it's very hard for people to chase the market or be in front of the market. What you generally do is just incur trading costs and increase your regret. So, as I said earlier, stick to a long-term plan. When shares or asset classes become a lot cheaper, a lot more expensive, that's when you need to make maybe decisions. In this up and down yo-yo environment, very difficult to make informed decisions that are meaningful, that we believe will add value to your returns.
Well, thank you, David Bacher of Corion Capital. This has been the Corion Report, and we will be checking in next month.
Thank you, Lucy.